Greetings traders and welcome back to another survival guide. Chris here bringing you some more information. And today we're going to be talking about Treasury Securities. That's right, you heard me right. We're going to be talking about Treasury Securities. That means Treasury bills, notes, bonds, even Treasury note futures. But before we go any further, please do me a favor and just click that like and subscribe button down below. It doesn't cost you a penny, and it allows me to continue coming out with these videos for you guys, so I appreciate it a great deal. But without further ado, let's dive on into that information and learn about how some of these derivatives are traded, as well as talk about some of the strategy as well. So here we go. When it comes to low-risk investments, nothing says conservative like Treasury Securities. Many investors turn to these instruments to preserve their capital in times of turbulence and in other market uncertainty in the financial sector. In fact, there's hardly ever any other investment opportunity that carries such strong safety guarantees for both principal and interest returns. But first, let's talk about exactly what Treasury Securities are. Treasury securities are debt instruments that are issued by the US government when it wants to raise funds for itself. They are also known as Treasury bonds. So if you hear Treasury security or Treasury bonds, they are synonymous. People who buy these instruments are essentially loaning money to the government to be paid back with interest over a given period of time. Buying Treasury securities is considered one of the safest investments because they are protected by the full backing of the US government. This means that no matter what happens, inflation, recession, pandemic, as long as there is a government, as long as there is a United States, then our principal is protected. Additionally, any interest earned on said principal is only taxed at the federal level. This safety guarantee is one of the key fundamentals of the economy itself. It is what makes the Treasury securities so attractive to both individual and institutional investors who are looking for steady returns over the long term. There are three main categories of Treasury securities: Treasury bills, Treasury bonds, and Treasury notes, and we will take a look at each of these in detail. First, we have Treasury bills. These are securities that mature in the short term, usually which ranges from a few days to a year, and they're also referred to as T-bills. There is no interest earned on T-bills. Instead, you can buy them at a discounted price compared to their actual face value. On the date that they mature, the principal amount will be returned to you, but this time at its actual worth. For example, if you were to purchase a $10,000 T-bill that was going to expire in 2 months and you only had to buy it for $9,900, after 2 months, the government will pay you the full $10,000 value, giving you that $100 of profit. The maturity period for Treasury bills are usually available in 5 different terms. We have 52 weeks, 26 weeks, 13 weeks, 8 weeks, and 4 weeks. There's also another variation of T-bills known as the cash management bill, which doesn't follow a regular schedule and usually matures after a few days. Treasury bills are the only type of Treasury security that exists in both the money and capital markets. Then we have the Treasury notes. Treasury notes are also known as T-notes, and they are intermediate to long-term Treasury securities with maturity dates typically ranging from 2 to 10 years. There are 5 available terms for Treasury notes. There's the 2-year, 3-year, 5-year, 7-year, and even the 10-year note. Like Treasury bonds, T-notes are issued at a par value with fixed interest payments paid out to the bearer twice a year. The principal is then paid out at maturity. Auctions are also conducted every month, with original notes being issued on February, May, August, and November, and reopenings during the remaining 8 months. The Treasury notes offer a viable middle ground between the relatively higher risks associated with the long-term T-bonds and the low-term payouts of the short-term T-bills. This makes them an ideal choice for beginners who are looking to get started with Treasury securities. Prior to 1984, the U.S. Treasury issued callable Treasury notes, meaning under certain conditions, the notes could be repurchased. The interest rates do vary, typically depending on the length of the term. And finally, we have the Treasury bonds. And the Treasury bonds have the longest maturity of all Treasury securities, usually 10 years and above, sometimes even as high as 30 years. Interest rates earned on T-bonds is paid out twice a year until maturity. You can buy Treasury bonds directly from the government or through a broker. They are issued at actual par value. So let's say you purchased a 20-year T-bond worth $50,000 with a 5% yearly coupon. The government will pay you $2,500 every year for the next 20 years, and at the maturity date, pay back the original $50,000 on top of the interest that you earned. Original issues of Treasury bonds are auctioned 4 times a year. February, May, August, and November are those months at which the auctions occur. The reopening of existing T-bonds and the re-auctioning is done within the other 8 months. Because of the longer maturity date, Treasury bonds typically have higher yields compared to other Treasury securities. Still, they usually offer better interest rate returns than bank savings accounts and even some time deposits. This is a very appealing option if you are planning on playing the long game or gifting it to someone beneath your generation in your family. The history of Treasury note futures is relatively young. Interest rate futures were introduced in 1975 by the Chicago Board of Trade, which we always refer to as the CBOT. At the time, the cost of money was experiencing frequent volatility, and it became necessary to come up with some kind of instrument to help mitigate the risks, and thus gave birth to the Treasury note futures. This led to the creation of Treasury bond futures, and then later the Treasury note futures for the 2, 5, and 10-year terms. The Treasury futures can help manage risks that are typically associated with fixed income security investments. In this case, however, we are speculating on how high or low we believe interest rates will rise or fall in the future. By investing in Treasury note futures, we can assess which direction interest rates will likely go over the maturity period and protect against associated risks, especially towards the end of a yield curve. The 10-year T-note futures contract is one of the most commonly traded Treasury securities. It is used both by individual and institutional investors. It is generally considered to be a good indicator of the current state of the economy. During times of economic turbulence, many investors flock to the safety of Treasury note futures to protect their wealth. This is known as flight to quality investing. It eventually leads to lower interest rates since more and more investors are entering the Treasury market. On the flip side, times of economic growth emboldens investors to opt for instruments with higher potential returns. This leads to less demand for Treasuries and rising interest rates. The Treasury note futures contracts are traded on the Chicago Mercantile Exchange, otherwise known as the CME. And this is what the T-note contract looks like. If you just take a look, we have our contract unit and it is $100,000 as the face amount. Then for the product code, we have ZN, and that is how we're going to find it. The price quote is going to be 100 points on a basis. The trading hours are pretty standard in that regard, and the rest of this information is actually available on our site if you're curious on pulling it up, or even over at the Chicago Mercantile Exchange website. Let's take a moment to talk about the relationship between price and interest rates. The prices of Treasury securities typically have an inverse relationship with interest rates since the rate of return is fixed at the time of issuance. This is the case for most fixed income securities. This means that if the price goes up, the interest rates go down and vice versa. It is important to be aware of this inverse relationship because it can help determine ideal times to buy Treasury securities. Let's say a 10-year Treasury bond pays a coupon rate of 6% and interest rates go down to 5%. It makes sense to buy more bonds. There are many reasons why interest rates may rise over a given period, and some of those reasons include things like rising demand for loans and other forms of external funding, or allocation of bonds assets into stocks in a bid to maximize potential returns, or fiscal policy changes, or monetary policy changes. Conversely, interest rates may drop for a number of reasons that include lower demand for loans, financial uncertainty that causes stock investors to turn to Treasury securities as their safe haven, or introduction of interest rate cuts as deemed necessary by the Federal Reserve Board. Barring any events that can cause sudden economic changes, for example, the COVID-19 pandemic, broad changes in interest rates in the U.S. have often occurred over several months or even a few years. This makes the Treasury market relatively stable over the long term. Now let's jump into everybody's favorite part and talk about some strategy, some trading strategy for Treasury securities. The first strategy that is generally accepted is the buy and hold strategy. And as the name suggests, you simply buy the treasuries and hold them until maturity. It's pretty simple. This strategy is ideal for beginners and investors who favor the passive approach. Keep in mind that this takes discipline because we have to hold and not do anything else. And sometimes not doing something is harder than doing something. So don't underestimate the buy and hold strategy, and it is considered to be a relatively safe strategy after all. Then we have laddering. If you're looking to be more active with your trades, then you can buy or sell treasuries directly on the secondary market. Of course, this means the purchase prices and subsequent returns will no longer be based on the face value of the security, since you won't be holding it to its maturity. In this instance, laddering can be a great starting point if you're interested in not holding to maturity. The strategy simply means you're acquiring multiple bonds, each with its own maturity period, whether long or short. When one bond matures, you collect the returns and use it to buy another security with a longer term maturity. This way, you have a steady income stream while also being able to withstand possible changes in value to the other treasuries in your portfolio. Then we have swapping. This is similar to the laddering strategy, except it involves taking advantage of tax write-offs. Under swapping, you're selling treasuries that are not likely to recover and get a tax write-off for the loss itself. You'll then use the proceeds to buy securities with a high probability of profitable yields. It's basically cutting your losses and investing in stronger assets in order to maximize returns and to hedge your portfolio. Obviously, this strategy is more suited to experienced investors who can afford to take on more risk and can absorb more potential losses over a short period of time. The advantages of trading Treasury securities are quite wonderful, the first being the fact that there is guaranteed returns. They are among the safest investment options that are available today. As long as the US government is functional, you can be sure that you're going to be receiving what you are owed when due. Then we also have a steady income aspect. T-notes and T-bonds pay fixed interest rates semi-annually. This means that you'll know exactly how much you're getting and when to expect it. And then we have the various maturity terms. There are several maturities to choose from with the Treasury securities, so it's easy to find the one that best suits your goals. And then also, we have tax exemption, and everybody likes this one, right? Interest on treasuries is only taxable at the federal level. State and local levels are tax-free. And finally, we have the high liquidity aspect. Treasuries boast the most liquid markets when it comes to fixed income instruments. Even if you're not willing to wait until the maturity period, you can easily sell your treasuries on the secondary market. As far as the disadvantages, we start off with the fact of inflation. This risk refers to the inflation rate potentially being higher than the interest an investor may earn while holding the treasuries. In this case, your real return is negative and your investment actually loses value over time if the inflation outpaces it. And then also we have the idea behind the changes in interest rates that can negatively affect the treasury security. Fixed income securities can lose value if the interest rates increase, which kind of ties into number one. And then we have number three, which is the economic growth aspect. During good economic growth, businesses thrive and compete for capital from investors. As a result, the value of treasury securities decrease as there's more demand for higher risk investments that have better returns. To sum it all up, Treasury securities have been around for a substantial amount of time with a quite wonderful track record for the investors that have chosen to use them and used them properly. It's up to you to use due diligence, of course, as with all forms of investing, to decide if Treasury securities will fit your trading style or your trading goals. But other than that, they're relatively straightforward and have some very cool aspects about them. But until next time, folks, thank you for joining me as always. I wish you the best of luck in all of your trading, and if you're still here, please click that like and subscribe button below if you haven't yet. I will see all of you very soon.